Hi everyone, it's Grant Abbott speaking, and first off, thank you very much for making this one of my most attended webinars. Look, from obviously you've seen a lot of the stuff that I've been doing around the SMSF party. I didn't really expect it to be taken up so seriously, but obviously there's a huge concern around most people, particularly the SMSFers, like myself, and the impact that not only the Liberal Party but also the projected Labor Party changes are going to have on our whole system, which is the core of what we're looking at today, both strategies to do before and also post-election. From that perspective, not only that is obviously the self-funded retirees and our small business owners. There's more than a good friend of mine, Succession Plus Chairman Craig West, says there's more than 1 million baby boomers who expect to sell their business in the next 10 years, which means obviously that's their nest egg, and that's going to be severely impacted potentially by a lot of these measures that are coming through. I suppose from the SMSF party point of view, this is not a political issue because we want to get to the strategies, the stuff that makes you really makes you guys buzz and get out to the clients, is that look, I was fed up with lobbying for so much, for so long, and really from our perspective, it's a way of getting in front of the game and making sure that we're in a position to make changes. Anyway, normally, oh gosh, I've been through so many elections. I remember, sorry, showing my age here, I remember when the old, I remember when Gough Whitlam was election. I think that's the first election I ever remember. I vaguely remember Harold Holt. And then was John Gorton, and then I remember Gough Whitlam because that was 1972. It was the It's Time election. I thought that was a really amazing. And since that point in time, I think from that perspective, is it's generally been very genteel. Of course, this is what they do the big town hall, and then this is what our doing, and the other guys are terrible, and all that sort of stuff. And it was all very genteel. Everything was okay, but I don't know what's happened to politics in Australia for the last 10 years. It's gone absolutely crazy. How many prime ministers do we go through? Just like a revolving door. And now then generally what would happen is you'd say, okay, these are the policies. No one would dare raise any tax or other issues. And then what would happen, and Costello and Howard are brilliant at this, they go in and they get in there and they say, oh my God, can you believe the budget is so bad? So next minute, there's nothing in the kitty. So bingo, bango, bongo, suddenly there's a whole lot of new taxes that are imposed on us. Howard and Costello masters the art. And look, before that, Keating and also Hawke were also pretty brilliant at it. Really, at the end of the day, they're played safe. Don't give the electorate an issue or target to turn the vote against you. And really, if we look at it, probably the last, the Liberal and the coalition government have lost the last 100, is that right, or 100 or 60 or so Ipsos polls or news polls, so that they're virtually dead man walking. And so really, the coalition government, they were about to go an election, and they can Turnbull. They canned Abbott, then they can Turnbull. And I would say that, from my discussions, certainly going around Australia and talking to a lot of the SMSFers and people in there, and really that, from that perspective, is that they sort of turned their back on the Liberal Party because they were just as bad as what the Labor is. And I know certainly last election, a lot of people virtually did vote independent in a number of instances, or didn't vote at all, which is a bit scary. But here's the thing. What's the opposition like the Labor Party? Again, I'm just looking at it from a political perspective. They're putting out such detailed policies and really rubbing so many groups' noses in it. Ravi just said, thanks, Ravi, that from Morgan's down in Richmond, down in Melbourne. I love you guys. That there was a big issue on franking credits and all that in the 7:30 report last night. And I think that, look, Bowen's hubris, and certainly Shorten's hubris, is starting to wane a bit. I mean, it was only last week that Bowen said, look, if you don't like the measures, don't vote for us. But getting to the stage now that so many people aren't going to vote for them. And really the polls are starting to close. And look, I don't know. I still think that A lot of people are going to say, well, I don't want either of this lot in there. But, you know, this was an unlosable election for them. All they had to do is keep their powder dry, walk in and do the old Howard Costello bingo, bango, bongo, and then say, oh, by the way, we've got to get rid of LRBAs. Oh, sorry, we've got to do this, we've got to do that, rather than, you know, coming out and, you know, saying all these things. And even, look, the Medivac issue that went through Parliament last week, you know, I've got nothing, you know, I don't say anything about immigration. It's just a completely non-issue, but suddenly they're being targeted, and look, all they did is keep their powder dry. But anyway, let's wait and see. The election's coming on. It looks as though the writs for the election will be in early April. We've currently, for the SMSF party, we've got our 500 members, so thank you for that. We're up to about 2,000, and so it's in front of the Australian Electoral Commission, so we should be up and running very shortly. I can't believe so many people are donating to us, so thank you very much. But it's going to be a very grassroots campaign, and we've got some amazing candidates, a lot from the financial services, and when I mean from that, the accounting area, bankers and retired bankers who, look, there's some really good, strong candidates who will be able to muscle anyone in Canberra, which is great. So let's not forget, before I get into the Labor stuff, what we've got to do before and after, let's not forget that our mate Morrison, when he was the Treasurer, gave us the $1.6 million T-bar. And someone raised the issue. Sorry if you're on the call. You raised it with me last week, but I get so many messages. And look, I appreciate all the feedback you give. You know, all the support is just amazing. But I remember the pension RBL. Do you remember the pension RBL in 2007? It was 1.6 million. We've gone on for, you know, 11 years now, and the T-bar is 1.6 mil. I haven't got it in the latest slides, but the looks as though the Labor Party, if they get in, will reduce that T-bar even further. What they're going to do is probably chuck the T-bar out, which is the last thing. We just put the whole damn thing into place, and they're going to look at the maximum tax-free income that a super fund can earn is going to be $75,000. Now, of course, if you do that, you're going to have like 2 or 3 funds. We'll have to wait and see on that one. But really, there's going to be a lot of attack on that tax exemption in there. If I took you about 10 years down the track, I would say, and this is Grant again, would say that potentially that a self-managed superannuation funds or all superannuation will just be a flat rate of tax of 15%, potentially maybe even 20%. And again, of course, if we do that, then the excess franking credit issues are probably not a big issue anyway. Well, it will be, of course, because there's a lot of people getting it. And remember, Morrison dropped it from 300 to 250. Remember that 15% extra superannuation surcharge? Gone from $350,000 to $250,000 of income a year, then you're up for that extra 15%. Drop the concessional contribution limit to $25,000. I basically have never forgiven them for that. I just think that is absolutely disgraceful. That really, when you're in that capacity, a lot of people, small business owners, people salaried. I mean, even myself, you know, you're paying kids school fees. I've got my 16-year-old daughter down in Melbourne, and she's at St Leonard's, which is a good school. I mean, it's not like Ivy League or like super glamorous. $33,000 for tuition. I wrote back to them and said, look, sorry, does this include all the add-ons, you know, all the things they do, this? No, that's just straight tuition. And that's a pretty heavy duty to pay. You've got 2 or 3 kids at private school and you've got mortgages, and mortgage rates are low. Can you imagine if they went up a little bit? And there's a lot of financial stress out there, which means that the only money that's going into super is effectively SGC. And so this catch-up after age 50, once the kids get off your hands, although I've got a 21-year-old, they're never off your hands, they've always got that little hand out there. From that perspective is that we want to start putting more money in, but if we can only put $25,000 in, you know, we're trying to retire at age 60 and enjoy our retirement, it's just not going to wash. So, look, it's got anything to do with the Labor Party. This was Morrison, our Prime Minister, who put this in place and dropped the NCC to $100,000. I don't know why. Why have $100,000? Why not just make everything $25,000? It's ridiculous. And look, from my mother's perspective, and I know a lot of people out there, is that Centrelink assets test has dropped from 1.3 to $800,000. That makes a huge difference for people. And look, again, it was Morrison. Sure, you're shaving some money off the system, but all these little things that once you start implementing them, they go lower and lower. So it's 800,000 now. What's it going to be? 700? I mean, it's supposed to be going up with indexation, not down. And like SGC, can you get any lower than 25,000? Even now, people on significant packages are blowing that apart just with their SGC. Okay, let's get straight into it with Labor's sorry, that didn't wake you up, non-refundable franking credits. Well, what an issue. In fact, I think it's probably a big issue. So excess franking credits non-refundable, that's a market disruption. First off, we can see it is probably pretty well targeted at SMSFs. And if you have a look at it, the premise, and I've been through all of the Labor Party platforms, all Bowen's musings, his press releases. In fact, CANS, or the Institute of Chartered Accountants, have got a great paper on it that goes through like about 20 or 30. It's a brilliant, well done, CANS, for doing that. Market disruption, we're already starting to see a sell down in bank stocks and obviously Telstra, because if you're not going to get value for those refundable franking credits, then you're going to have to look at what the underlying cash return is on those investments. And that makes a huge difference. If you're getting an extra 2% because of franking credits coming from the government, that's pushed everything. In fact, it's had a huge change. If you have a look at someone like Wilson HTM, the fund manager, if I took about 15, 20 years ago, all funds were unit trusts, so they're straight flow-through mechanisms. But what has happened over the last 15 years, they've now, since 1999, when they changed the laws allowing refundable franking credits, they've all moved to listed investment companies. I remember when I worked at Rothschild, LICs were always at a discount. They were dogs. And effectively everyone would go through a managed fund. So what will happen is we'll actually end up going back the other way anyway because of the franking credit issue. So companies were the main investment vehicle, but we're going to find that that's potentially going to be a change. At this stage, there's certainly no going backwards. Both Shorten and also Bowen have basically said, well, this is it. This is what's going to happen, which is patently unfair because effectively, if I'm an industry or retail fund, my pension members are, here's an issue for you, my pension members are generating huge franking credits, which was said. That is passed back, and listen to this, that is passed back to the accumulation side of those funds in order to have two impacts. First off is to reduce the income tax liability on the underlying earnings of the accumulation holders or the lump sum superannuation interest members of that fund. Secondly, it'll go to ameliorate, and this is pretty important, will go to reduce effectively the contributions tax liability, the members. So given the fact there's huge swags of SGC going into industry funds and not so much retail funds, they seem to be going backwards now, particularly after the Royal Commission. Effectively, what we've got there is that the industry funds will always utilise those credits. That's because they're a big fund. You're looking 400 or 500. Even if you had 10,000 members, you're always going to start to utilise those credits. And primarily, a lot of it's going to be used for contributions tax. Hence, from those large funds, they pay virtually no tax because of the franking credits. Now, when you have a look at the small super funds, generally we can't do it because 92% of funds are mum and dad funds or just single member funds only. So they've been only those excess credits they've been using as refundable. But really, side by side is the ability for the industry funds to transfer. And here's one thing is, for those clients, I've never seen it. There must be somewhere in their trustee what payment is going from the accumulation or the contributions tax users to the pension members inside an industry fund. So just raise that one. If anyone's got that, is anyone good at going through that murky prospectus and the information memorandum material? Can you go through and actually work out, is there a payment and what's the payment? So there's obviously $1 franking credits going over being used by accumulation, but likewise, is there $1 payment going over from the accumulation side to the pension members to enrich them for the foregone loss of their franking credits, if that makes sense? Now, again, it's patently unfair just because someone's got large members that SMSFs are going to miss out, because it has the same impact. Because if it was, let's say there was no imputation credits at all. So if there's no imputation credits, and some people I don't know why they're doing or arguing against it. I saw a few of my old colleagues at KPMG saying it's a ridiculous situation, which is crazy. But if it did, then obviously industry funds would be impacted a lot more significantly than SMSF, simply because of the size of the franking credits that they get through. So again, it's not a level playing field, but remember, we're up against a Labor opposition that effectively, when we have a look at it, we're up against a Labor opposition that really are there. And when I go through each one of these, at the end of the day, there's only one conclusion that I can make, and only one conclusion, and I'm not being cynical, but to me, is they're hammering everything except industry funds. Industry funds, my belief is they're looking to make them the preeminent and the most concessionally taxed vehicle in Australia. Again, I say that industry funds, the most preeminent and concessionally taxed investment vehicle in Australia. And I've seen that because when people started complaining, and they should never have said this, when people started complaining about the excess franking credits not being refundable, what was raised by one of the industry fund leaders is, well, why don't you wind up your self-managed super fund and roll it over into an industry fund? Can you believe that? Moving from a free market to a union-sponsored fund. I can't believe that. But that is their way out. And again, flip side is you go through each one of these measures and start to have a look. And to me, it definitely looks as though they're looking to make industry funds the most preeminent vehicle. I've just got a couple of questions here. Hi, Grant, from Daniel. Thanks for that. Would the removal of franking credit refunds affect retail industry funds as well as they mostly have separate pension funds from accumulation funds? That's a really good question, Daniel, but you'll find they do have separate pension funds and accumulation funds, but here's the deal. They are sub-funds. They're still covered by the same trust. So the franking credits, remember, it's the trustee that pays the tax, so that's still a flow through. Otherwise, there would be a problem. But really good question there. Yeah, exactly. I was a bit disappointed in the Royal Commission that they actually didn't flow through and have a look at all the money that comes out and goes to the industry fund services and see where that money ends up. But anyway, let's move on. So here's a couple of things, 3 strategies. First off, fixed unit trusts will come back in. Just like they were in pre-2000, you're going to start to see more managed funds that will actually be directly for the benefit of SMSFs. And let's face it, the industry and retail funds have their own fund managers anyway, so it's very unlikely they have wholesale funds. So we're going to start to see guys like Wilson HTM won't be listed companies anymore. Guess what they'll be? They'll be managed funds, and then there'll be a straight flow through of income. So that won't be a bad situation. Likewise, we're going to talk a little bit about fixed unit trust for us when we get round to the discretionary trust issues. Bloodline family SMSFs, I'm going to be talking about this at the roadshow. If you've got the time, please, I'm going to talk about it later, please come and hear me for 3 hours, talk about all of these things and some great strategies, particularly when we get round to bloodline family SMSFs. I only hope, touch wood, crossing my fingers, I've got everything crossed at the moment. This isn't going live, I've got everything crossed. Let's hope that the 6-member rule gets through. I can't believe it has took them so long to get that on the table. That's the Morrison government, because effectively it was only really a requirement in Section 17A, and that flowed through to different acts. So if that gets through, then we've got 6 members in there, and look, it's important for all of us to lobby the crossbenchers to make sure that it gets through prior to an election being called, because that then enables us to use a couple of things. First off, a basic strategy, here's a good one, getting our younger adult members, and for here, once you hear me talk about bloodline, you'll never go back. You go through the door, you never go back. What will happen there is you get your bloodline into your self-managed super fund, rip them out of the industry funds, rip them out of retail, put them into a sub-fund in an industry fund, and then what will happen is the same way that industry funds transfer franking credits from the pension side to the accumulation side, in exactly the same way will happen for the younger members. Now, the issue will be, from a family perspective, a bloodline perspective, is will that be $1 for $1? So for every dollar that's used to reduce the income tax liabilities inside the accumulation account, or more importantly, the contributions tax liabilities, then effectively, if we can get to that position, then what we want to do is we want to be in a position effectively of utilising those franking credits. The question is, do the younger generation, I'm not talking about, if we've got 6 members, we can have not only second but third generation in there. So if there's contributions going in on their behalf, then effectively we want to work out, is there a dollar for dollar, 50 cents in the dollar, or no dollar payment at all? It gives us flexibility. Now, more importantly for that one is, remember the $25,000 concessional cap. If we go above that concessional cap, and I'll be doing a few case studies at the roadshow showing if you did $50,000 or $75,000, that if you've got those franking credits, even if we've got individuals, as long as they're under 75, still contributing, then the value of those excess credits, sopping up those contributions long term, makes a huge difference. And what I do is don't think of $25,000 as a cap. If you've got franking credits, there is no cap anymore, which can then go down to advanced strategy 3. Now, this is a bit out there, and I'm going to tell you up front, this is a bit out there even for Grant here, because it's something I've always not sort of gone against. But we will find that because SMSFs aren't impacted by running members in and out of the fund, we will find that there will be people who will have large franking credits inside the fund. They'll run sub-funds, so the franking credit people will be walled off, and I've actually built this into my current or my new strategy deed, and certainly the bloodline deed, running sub-funds so the investments are quite separate from everything else, which would then mean other people who've got a big tax liability during the income year can float into that fund, effectively claim a large concessional contribution, subject to obviously their NCCs. And then what will happen is the franking credits will wipe that out. Now, again, they won't be able to pay dollar for dollar, otherwise it's not worth going in. Obviously, there's an excess concessional contribution charge, but you'll start to see that sort of thing happening where it used to be family members, but we might actually have members of a firm or a partnership inside a self-managed super fund. Again, something I've never advocated, but certainly with the right rules that can be built in, then it'd be worthwhile having a look at those through. I've got some really good questions here, and so if we have a look, Adam Parswell, you've got a good question. Like, if you've got a wrap account inside an industry fund and that has excess credits, what happens there? Well, I'd say you'll still get those excess credits there. Who knows? Gary Jackson, thanks for this. It is worthwhile you setting up an intermediary for your members to buy their shares through. If you have sufficient accumulation members, you could act equivalently to an industry fund and provide 100% refund of the credits. So I believe that's the case. The only thing that we've got to worry about is securitization or lending scrip to another party. There's a whole, I think it's section 26 BC of the Income Tax Assessment Act that we'll have a look, but certainly by the time that we get around to the roadshow, I'll have that well and truly on foot. Importantly from that one is, what I would like to see is that if there are excess credits, ideally, if everything was being equal, to make a level playing field, because I think either everyone's in or everyone's out. There should be an ability for people to transfer their franking credits to those who need be. So if we can try and we can certainly sell the franking credits over if it's in between a family SMSF. What I'm saying is the next stage on is if we go outside the SMSF, could we sell the credits? And of course, that probably won't get any leg up, because why? Because it would impact the industry funds. They want to be seen as the best. Now, I remember saying this going back about 6 months ago. No one ever believed me. They said, well, this will never, ever happen. But we've got a 30% flat rate on discretionary trust distributions. Again, go and have a look at everything, the Labor Party platform. Go and have a look at Bowen's speeches on the fairness of taxation. How that works, if that's a 30% tax rate, if there's then a rebate, it doesn't seem so that's the case. It looks as though just a straight 30% tax rate, which obviously means that for employees, we get salary and wages up to that 30%, and after that we could have discretionary trust distributions. But it means for adult children, our parents, those instances, even bucket companies, we're not going to use a bucket company generally because if we're going to pay a 30% tax rate. Here's the first thing. We have to get away, and look, I've been pushing SMSF advisors for a long time, but my background is tax law. I found my way into self-managed super funds and superannuation simply because it was the best tax game in town. But you can see it's getting smashed every little way going on. According to the Labor opposition, that there is no revenue gains from superannuation or self-managed super funds, that there's actually payments going out. So there's a net revenue loss because of franking credits. Of course, they're going to start to hammer that. So from my background, we need to know everything. If you're licensed, you're licensed to provide advice around all financial products and SMSFs. You also now need to be part of the tax practitioner board, so you're able to give tax advice. From that perspective, we need to be in a position whereby we know everything about every structure. So, for example, if I looked at a bloodline, and again, you'll hear more and more about that from me because it certainly is the topic of the day, but you'll be able to build a bloodline family trust. You'll then, from the bloodline discretionary trust, subject to these trust distributions, you have a bloodline bucket company or bloodline company. You'll then have, of course, your bloodline SMSF, your bloodline testamentary trust, your bloodline superannuation proceeds trust, and your bloodline pension. So I've built all of that in the LightYear documentation suite. Now, you don't have to use it. You can have non-bloodline of all those things. But the key thing is we need to know how each and every one of those structures work, because when we're looking at our client, we're looking at their holistic family wealth. And it's not just one, it's second and third generation. This hasn't been done in Australia before. We tend to just focus in on one or two members. We need to look at, or one or two clients, we need to look at their whole family tree and see how it can be utilised, maximised, leveraged for the purpose of not only reducing tax, but also maximising wealth. From the discretionary trust distribution side of things, again, it's going to be from a certain date. It doesn't look at this stage whether there's any lobbying. And as I said, lobbying doesn't do anything. That's why the SMSF part is important, to go and say you cannot do this flat rate distributions for small business. It's criminal. Farms and charitable trusts are somehow given exemption. Now that's great if you're a farm or charitable trust, but where does that limit go? Small business, I don't know why that is out there. Certainly from an investment point of view, investment discretionary trusts are a big issue. So there's 630,000 family trusts are going to be impacted. Now, it doesn't look, although they come up a little bit later on, talks about no retrospectivity, but it doesn't look as though they're going to do a grandfathering on these flat rate discretionary trust distributions. So strategy one, move to fixed trusts. I just built a great one for LightYear Docs, which is being launched at our roadshow. The first one, hopefully for those guys in Western Australia, on the 27th. Next week, in fact, I'm going to be over there, so I'm going to have a lot of fun. The best one to look at is if you go and have a look at New South Wales OSR, in order to get a land tax exemption, effectively what happens is you need to have a fixed trust. And then if you've got a fixed trust, from that perspective is you can potentially get a land tax threshold exemption for that fixed trust. So if we have a look at that, that's a prime one for us. And I've built some documents around that. So that will be one of the first strategies we can potentially use, is going to fixed trust. But then we go back and say, okay, well, if we're going to do that, why not just go to use companies, particularly where companies by 2021-22 are going to be taxed at a 25% tax rate. Why would we use discretionary trusts? They're going to be a flat rate of tax at 30%, when inside a company we've got a 25% tax rate with imputation credits. And of course, I've just beefed up quite severely for the LightYear Docs our Div 7A agreements. So it's funny, we're actually going to go back 20 or 30 years, and companies, if discretionary trust distributions come here, companies are going to become more the norm. And certainly, it used to be the case where you'd say, well, hold on, you haven't got a big CGT issue around this particular CGT issue, saying that companies don't get it. But remember, our capital gains tax discounts are now going down from 50% down to 25%. So companies are not a bad position. Okay, let's go into negatively geared rental property. I thought you're just going to love this one. This is just, remember how they're going to, anyway, let's just go through it. It's just funny. I love going back through history. This is from Jim O'Donnell, Jim, quarantining interest deductions for negatively geared rental property investments, 2005 General Tax Review. So you can have a look at that. And this I just pulled this paragraph out of it. It's quite a long paper. But the government introduced legislative changes which effectively abolished negative gearing for real estate investors. Now, when we go through, it's not going to be only real estate and the new rules. It also talks about shares as well. So the restrictions affected only real estate purchased after 17th of July 1985. The reform quarantined any losses made from owning rental property so that only excess of deductions over rental income could not be used to reduce tax on other sources of assessable income. However, losses could be carried forward to offset against future rental profits and reduce taxable gains made from other rental properties purchased after that date. The quarantine measure was justified on three main grounds. One, taxpayers should not have to subsidise rental property investors. Two, negative gearing resulted in increased home prices to the detriment of ordinary home buyers. An estimated net revenue gain of 55 million, 86, 87, 100 million in 87, 88, rising to 195 in 90, 91 and subsequent years. Now, it's funny because if you had a look at that, Bowen seriously just pulled that out and just slammed it into the policy. So we're going right back to the future. Remember those guys? It's like, anyway, obviously I haven't thought a lot. Now, here comes the cream on the cake. You ready for it? And I love this one. Due to various pressures in one of the more remarkable backflips in Australian tax policy history, the government removed the measure effective from 1 July 1987. So it only lasted 2 years. According to official records, repeal of the measure was justified on two main grounds. Uniformity of tax treatment of interest costs for all types of investment, so now they're actually going for all types of investment, and the belief that excessive tax benefits offered to high-income earners by negative gearing were adequately countered by other tax reform measures, notably introduction of the CGT regime, which happened obviously in 86. There are also, this is probably more, there are also unofficial reasons for the quick repeal of the measure, including an impending federal election and complaints from the New South Wales facing a state election. That's what I can't believe, guys. Look, I've just gone through, they've just smashed small business, discretionary trust, smashed the accounting industry, refundable franking credits, just said, well, anyone who's living off these, part obviously there's an exemption there for pension members, which includes self-managed super funds to a certain extent, depending on the date. And now negative gearing, they've virtually gone in. Can you believe this, going into election and saying, we're going to smash all of you guys, and then hopefully that the younger base is going to flow through and give us the votes. Look, I'm not quite sure. But one is, look, here's my issues. This is real. It means that new properties are obviously going to be exempt. They're bringing back the NRAS scheme for housing affordability. I mean, that was rorted right from the start. Remember, guys, developers actually would increase the price in order to get the discount. Anyway, the NRAS is coming back in. The new properties are exempt, but share and other investments are also caught up in the negative gearing. I delved through the party platform. So everything is going to be caught up there. So that also means people who are in existing stock are going to stay in that stock while it's tax negative. And when it goes tax flow positive, which is okay, they won't move. They may well try and move in, but they'll go for new stock. So this is what happened, like going back 24 years ago, 85 to 87. The whole home buying market just dropped on its head really quickly. I don't think at this particular point of the property cycle, given what's happened since the Chinese have moved out of the market, I'm just not sure that we're really not adding fuel to a fire that is really going to destroy a lot of wealth. But again, as I said before, if I wanted to make industry super funds the preeminent savings vehicle in Australia, all of these measures work in tandem to exacerbate that. So, shares, how do negative gearing excess franking credits work? So I'm not sure about that one because obviously if we are going to put in shares, we gross up the franking credits and then we get an interest deduction based on both of those, but we'd be left with franking credits from that. Now, obviously, a nice way and twist is it's not a bad idea to continue to do negative gearing of shares or manage funds, particularly if there's a franking credit there, because it'll be grossed up, you'll take off your negative, but you'll then be able to get that franking credit and utilised against salary and wage income. Does it make sense? You utilise it against salary and wage income, those franking credits. So that seems to me to be a great way, and just making sure that your gearing level isn't over and above the value of the share and also the grossed up franking credit. So again, that's one strategy there. I'm not sure. We've got it there. So utilise gearing on shares with franking credits for salaried and high income professionals who can use the credits. So again, we can get away with one strategy, but actually pushes it back into the shares, which is great. Strategy 2, negatively gear in SMSFs. Here's the thing. Isn't this amazing? When you negatively gear outside, it's going to be quarantine. But inside a self-managed superannuation fund, the question is, will it just go against that specific property? Or alternatively, can we offset against contributions tax? I think possibly if it's against a specific property, we will be locked in. But if we can negatively gear and again, going back to strategy 1, negatively gear, again, we could use a related party loan into our superannuation fund, again, to get the value that the interest deductions equal the grossed up amount of the franking credit, and then absorb those franking credits to reduce their contributions tax liability and the rest of the liability in the fund, then it's not a bad strategy for high income professionals. The other one, strategy 3, is look at tax sheltered investments like ESIC. So this is quite separate in a different bucket, and the Labor Party hasn't looked at this, but it's pretty hard to knock it on the head because otherwise you're going to be targeted as a non-innovating party. So early stage innovation companies provide a 20% tax offset on capital investment. So it's not negative gearing where you're getting a write-off your deduction. You're actually getting a 20% tax offset on your capital. So, for example, if you invested $50,000 through your self-managed, or even just as an individual, you invested $50,000, then you're going to get a 20% tax offset or $10,000 tax offset, which can be used against your other assessable income. Like the excess franking credits, it can't be carried forward. It has to be used in the year. But importantly, there's no CGT. So these ESIC companies, and we'll be talking about this on the roadshow as well, these are pretty good solutions for us, for our clients. We need to start thinking about different things. Gary Jackson, gosh, you're on fire today. Maybe I should have got you on here to help me along. Read negative gearing. People seem to forget that investors are paying much more in GST and don't get GST relief on rental income. True. Plus, we're selling a high value asset, have much higher capital gains tax to pay, particularly if we're dropping from 50 down to 25. It is a big distributable over multiple years, plus are paying much more high state land taxes when owning investment properties. Is it possible to get a recording podcast this webinar? Absolutely. So it will be available. Again, Gary, you and I, we all know this isn't fair, but there's an umbrella thematic around it that, again, all of this pushes towards industry funds. And I think the government, again, as I said right from the start, I don't think that they realise the anger out there from all of us around these particular issues. How many people have they upset and really ticked off around that? Anyway, let's have a look at Labor's CGT reduction. So super funds, isn't this clever? Super funds are effectively, apart from, I'll talk about retrospectivity shortly, but super funds are going to have the highest discount rate, 33.33%. I wonder why that is. So there is grandfathering will help. What is the date of the commencement? Well, I can tell you if they get in, there's going to be, let's say there's an early May election. If the Labor Party gets in, this is what will happen. It'll be like 2 weeks after, or maybe 3 weeks, they'll check all the budget and then bingo, bango, bongo. Oh, all those things from this date onwards, or from the 1st of July 2019, all of these measures will occur, arise in place. And can you think about, here's a thing I'll challenge a few people. If this is what they're going to an election with, in an election year, these are the changes they're going to make. Can you imagine what's going to happen once they get in power? It's going to be crazy. Anyway, let's go down. Small business owners will get the small business exemption, but the 50%, you know how you get an ordinary 50% exemption on the sale of your business? That's just under the ordinary rules. That's going to be dropped down to 25, which means then you're going to have to use more of your 152Bs and Cs and Ds in order to get that exemption, so you don't have to pay so much tax on your small business assets if you meet that small business test, of course. But the problem about that is that they're then tested from non-concessional rules or non-concessional caps. So what they're effectively doing is by reducing that, they're actually increasing the amount that will effectively be absorbed ultimately through a non-concessional. So, do you know what I mean? They're putting a wall up on the small business, that money to go in. And someone raised there before, this sort of stuff is not being talked about in 2GB. It's not being talked about in 3AW, whatever. I've had a chat, and certainly once we get SMSF party up, I'll be running it really hard, going out and talking to all these people, which is crucial because these are issues that are impacting. Look, how many people is it impacting? Every baby boomer selling the business is going to be impacted. So let's go on. So strategy 1. Move listed shares and negatively geared property using a related party LRBA before the election to clear both. So what I'm doing, move the listed shares and negatively geared property into a self-managed super fund, if we can do that. So using a related party LRBA. I'll be going through the process at the roadshow. If you've never done a related party LRBA, you'll be able to do it like in minutes. I guarantee all the documentation. So before the election, I'll be clearing all the decks because LRBAs will be gone. So we want to make sure we get our related party loans. You fit in with Commissioner's PCG 2016/5. I'll show you how to do that all on the roadshow. That'll mean that we get that 50% discount now. Plus, if there's any tax liability, we can use our concessional contributions and a concessional contribution cap-ups for our clients. So this is something to do definitely beforehand, and definitely before they make changes. If they say it's from the 1st of July 2019, we basically want to make sure we move pretty quickly. Strategy 2, take the profit now on stocks. So if you've got profits on stocks, turn it to cash because, look, I'm not sure anyone would say that, at the end of this year, the market's going to go up. Take the profit, get the capital gain, you're getting the discount, then use that to either invest outside of super or inside super, or use a related party. You can, as I said, you go back to strategy 1, use related party loans to switch it up, and then put it into SMSF. And if the market comes down, then you're going to be in a position of a pretty good position. Except, of course, if you're negatively gearing, you just got to be careful with that one as well. But I see personally the reduction from 50 to 25% as a huge chunk. I mean, that makes a huge difference for a lot of us. Okay, Labor super changes, LRBAs to go. So get in now, particularly related party LRBAs, through the roadshow. Make sure you come along. If you haven't heard me speak, look, I've got a super prize coming up. It's a great way to get CPD. Can you believe you guys, sorry, I love you so much, but this is an hour CPD for you. You need, if you're licensed, to get 40 hours a year. This is probably, it's the least expensive but the most dynamic and the strategic CPD you're going to get. It would come in the category of probably compliance around that because there's 5 categories you have to do your CPD over. You can't just do technical the whole way. So this is probably more about compliance and also looking after clients. No employee deduction for that. So strategy, what I'll be looking at doing is using it now. So using a related party loan, transferring your shares in, transferring property in, and maximising both the no employee deduction. So obviously you're going to get the employer, they're going to get rid of that, and also the 5-year CC catch-ups out the door. So see what you can do to these two before the election comes up. That's absolutely crucial. What capacity have you got to do that CC catch-up? Particularly if inside the fund, there's a whole lot of franking credits to wipe out that contributions tax. NCCs have dropped to 75k. Oh God, that's ridiculous. 3 years of 75k, that's 225. And what were we only a few years ago, NCCs per year? Well, anyway, I just find it extremely frustrating. It was 180 just a while ago. 3 years is 540. Now we're down, well, virtually 50% drop. It's just crazy. Extra 15% super surcharge for high-income earners dropped to $200,000. That's crazy. SGC, here's the first one. A couple of things there. They're going to move to 12%, and I'd say that'll happen by probably the 1st of July 2020. It'll jump up to 12%. So that has a double impact. First off, is there's a lot of money going where? Into the industry funds, of course. And they're also looking at making that every salary. I can tell you straight away when they get in. Now, superannuation won't be paid quarterly. It'll actually be paid every salary date, if not monthly or fortnightly. It'll have to be paid into the relevant fund. And of course, industry funds, the default funds will be what? We all know that. They're going to be industry funds. So from that perspective, that's going to have an impact on a business having that extra cost. At the roadshow, I'll show you how to use robotic processing automation. I just sat down with a colleague just before this seminar and looking at automating SOAs, which I thought would never be possible until I had a look at this latest RPA system. So there's a lot of excitement around that to enable just a small business like a 1 or 2 or 3 man advisory, a professional business, to really punch above their weight, equivalent to a $100 million business using RPA, and we'll show that on the day as well. Now, importantly, in terms of Chris Bowen, this is his positive plan to help housing affordability. A lot of this is, can you believe that they introduced all this just before the election? What are they going to go to their big policy when they do their launch? What's going to be in there? Virtually nothing. Labor recognises Australians make financial decisions on good faith on the tax arrangements in place at the time. While making change to the tax system to improve fairness is a policy objective of Labor, it must be done without negative retrospective impacts on existing investments. The same approach was taken by Labor, the announcement policy to curb generous and excessive tax concessions for high-income superannuation accounts. Does that mean, say, if you are in a whole stock of shares and you're getting franking credits, you'll continue to be able to get refunds? I don't think so is going to be the case. So with there's good question from Kathy Kelly. Thank you for that. In terms of CGT and negative gearing, as I said right from the start, is effectively they are going to be grandfathered. The only issue that I have around that, both of those, is they may be grandfathered, but the impact, if you go back, particularly negative gearing 85 to 87, and you saw the drop in the market for property, is that you might still retain your 50% capital gains tax exemption or reduction, but it doesn't help if the market then drops down by 15 or 20%. I think it's important to come to the clients with all of these strategies. And look, at the end of the day, it's not our decision. If we are advisors and we need to go through the process of saying, look, there's a lot of changes going on. You need to have a look at these. Here's some suggestions. Here's some strategies. There's plus and minuses for each. But again, if the market falls by, let's say, 30% next year. So, for example, if you have a look at the moment, the investment, the residential investment property market in places like St Kilda and all that's dropped 25% in the last year. If it drops another 20%, the fact you're still retaining 50% CGT reduction is neither here nor there. But that's not our issue. That's our client issue for that. And I think that's absolutely crucial. Now, of course, all of these changes, I mean, that's why the SMSF party is in there to help to retain that. But it's important for us all to get out in front of our clients and saying these are the issues of the day. There's a whole lot of stuff that's going to be impacted on them. Because, again, if a client doesn't want to get out of a property because they've still got the negative gearing on that property, then the property goes down and they have a forced sale. Well, who knows what's going to happen. But anyway, we're advisors. We want to be in front of that. make sure you come along to our strategy, our systems. I'll look at RPA. I'll be going through a lot of these, and I'll be going into a lot more in depth and some really great strategies around contributions, estate planning. I've got a really good session there, sessions around ESIC. For those of you who are licensed, in fact, I dealt with a dealer group just today, and they were saying, look, most people are going to have to do 4 or 5 courses, and they're going to drop out. That's not the case. I've got Bronnie Speed coming along. She's a queen of FASEA. We just did a big seminar last week to a lot of media and also licensees, the Institute of Chartered Accountants, the FPA and the SMSF Association. Look, it's not as bad as you really think. It's in a really good position. So, look, from our perspective is I think it's a great opportunity to get on board, come and have a look at the roadshow. I've got so much. I'm going to jam like 10 hours into that 3 hours. And again, you get 3 CPD hours, 1 technical, 1 on client care, and 1 on the corporations, Understand the Corporations Act. So if you haven't logged in, just use the discount, 25%. I think it's only like, I think it's $75, so it's great value CPD. And plus, I'd love to see you there, and let's all get in and have a good, let's have a really good time around this whole thing. So, Michael Burnett, good question. What is your expected impact on the share market if invitation credit refunds are abolished? Well, if we have a look at it, there's $170 billion sitting in the share market. That's dropped down by 5%. Over the last probably 3 or 4 months, as people start to factor into the account, they're just assuming that those refundable franking credits are lost. There are some people I know who are getting 250 to 500,000. There will be a change in allocation in shares, and I don't necessarily think it will stay in shares, because you can virtually, for SMSF, there's the top 10 stocks and all franking credit stocks. So I think there will be a change, and we'll start to see a lot more managed funds. People will move there, but they may well move out of the share market altogether. And I think that's already starting to be factored in when we have a look at the current share market. Not sure, but anyway, look, it's great. Look, thank you for this quick smash out. What I'll do is this will be available this afternoon. I'll send it out to you, and more importantly, we hope that you look at it. We'll send it out with the slides. Love to see you at the roadshow. Come and say hi, and we'll have a lot of good time. Plus, I'll certainly keep you up to date with the SMSF party. Any questions, just simply send it to support@ilovesmsf, to support@ilovesmsf. We will send you a survey out today. You will get 1 CPD point from FPA and the SMSF Association. But more importantly, for those of you who are licensed, this is 1 CPD hour provided by our RTO, Terra Quarter. So it's 1 CPD hour. CPD points are great for associations, but they don't really wash with the FASEA laws. So send an email to support@ilovesmsf. Come along the roadshow. We're going to show you some amazing stuff, and let's keep all in touch. I just can't believe where we are at the moment, coming to election with all these tax changes. Remember the last time that someone went to an election with a whole lot of tax changes? It was John Hewson when he actually advocated the GST. I'm not sure where the Labor is. I don't know if they've backflipped, but all these impacts are going to have a significant impact on all our asset markets. Anyway, it's Grant Abbott signing off. Thank you all for attending today, and it's great to see you again.